In this presentation, we will discuss retirement savings contribution credit. For more information about this topic, see the discussion below, which will have links to relevant information within it, including a link to publication 590A, where much of this information can be found. In this presentation, we will discuss contributions credit. We're going to go over what is new and an introduction. This information can be found in publication 590A. We're going to start off with what is new. It's often good to start off with what is new because even if we're not familiar with the topic, we may have some idea of it, and we want to make sure that whatever concept we have that is in our head, that we unlearn any of the changes that are there, because that can be the most difficult thing to do. So we'll start off with the new items, and then we'll go into the introduction, what it is as of now, as of this point in time. So starting out, what's new? Modified AGI, or adjusted gross income limit, for retirement savings contribution credits have increased. So this is going to be typically over the years. Obviously, the AGI limits are going to be kind of our income type of limits. Modified AGI is going to be some modification to them. We're typically starting with, if we consider our Form 1040 and our Mock 1040, then the AGI is on line 7. And remember that anytime we see this modified AGI, we're basically taking the amount on line 7 and modifying it for something specific to the item that we're talking about here, oftentimes being situations that are a bit more unusual that we need some type of modification, and therefore considering mainly line 7. The line 7 is different than line 6, which is the taxable income by those above the line type of deductions, or those Schedule 1 type of deductions. So claim the retirement savings contributions credit if your modified AGI isn't more than $63,000 if your filing status is married filing jointly. So $63,000 married filing jointly, fairly low for married filing joint requirement for the credit. $47,250 if your filing status is head of household. So you have to qualify for head of household, not married, and qualifying for head of household. And then $31,500 if your filing status is single, married filing separate, or qualified widower. So notice there is a distinction then between head of household, which has a slightly higher, and the single filing status. And then, of course, as would be expected, the married filing status has a higher AGI limitation. Introduction. You may be able to take a tax credit if you make eligible contributions, defined later, to a qualified retirement plan, an eligible deferred compensation plan, or an IRA. You may be able to take a credit up to $1,000, up to $2,000 if filing jointly. This credit could reduce the federal income tax you pay dollar for dollar. So note, this is you can think about this. Why would the IRS have this in there? Note the incentive, of course, is to save for retirement. The IRS wants to help us to save for retirement, or incentivize us in some way to save for retirement. And this is going to be a credit, not a deduction. Dollar for dollar credit, way better than a deduction. In other words, if we had a credit and a deduction and they were the same dollar amount, the credit would be worth a lot more. One of the problems with putting money in for retirement is, of course, if we don't have a lot of money, if we're living basically paycheck to paycheck, or we have lower income, we're probably spending more of our money, and the IRS would assume then we're less likely to be putting money away, saving it for retirement. And so this is going to be an added kind of incentive at that point. So we're talking about the AGI levels that we saw in the prior presentation. We might have then a credit for us to put the money into the retirement plan. Because note, if we talk about these type of income levels, we may not be paying a whole lot of income taxes. So if we consider an example, we have our test 1040, we have the simple single individual. As we scroll down, we're going to say that the earnings are $23,000. So we have W-2 earnings of $23,000, and that rolls down to the total income and the adjusted gross income. So we don't have any adjustment at this time. So the adjusted gross income is the $23,000. We have the standard deduction of the $12,000 for the single individual. And so that brings down the amount of the taxable income to $11,000. Note the tax is $1,133 being calculated on that $11,000 at this point, with no retirement plan that we're going to put in place, with no contribution. So if we take a look at that tax rate, then we're going to say, okay, well, what's the tax rate that we're paying? It's about, the marginal is 12 and the effective rate is 10%. So then if we consider, okay, well, what do I can put then money into a retirement account. But if I put money into the retirement account, it's typically going to be lowering the 23,000, and usually I wouldn't get a dollar for dollar. So if I put money into a traditional IRA, then I could put a maximum of 5,500 into it if I'm under 50, and typically I would get a benefit of that in accordance with our tax rates. So if I put the max in 5,500 times, let's say 11%, and again, they're progressive tax rates, so then the benefit would be 605. So if you think about that, you can say, well, I have to put another 5,500 of money into some type of account that I can't touch in order to get, 605 reduction. Then maybe that's not enough of an incentive to put the money into the retirement account at this point. Maybe if there was an added credit on that, it might benefit it as well. Notice if I had a higher tax bracket and more available money, then it might have more an effect, because if my tax bracket was 25%, then you could see that the amount of the deduction would be more beneficial. So the IRS might be thinking here, well, considering the fact that the amount that's going to be benefited from a deduction for putting it into, say, a retirement plan like an IRA is lower because the tax brackets are lower, then maybe that we can supplement that with some type of credit at that point. So let's say we put the maximum in, then what's going to happen if we then put the maximum of 5,500, taking that money, putting it in to a retirement account. So the maximum for an IRA would be 5,500. Let's say we put 5,500 into the IRA. Then if we go back to our 1040, we can see that we have the 23,000 still of income. We got the 23,000 total income, and then it changes to 17,500 adjusted gross income, because of course now we have put money into the IRA and we got that deduction, 5,500. So we got that deduction. So that's going to adjust, lowering our income to 17,500. We still have the standard deduction of 12,000, and that brings our income down to 5,500. So now our tax is 553, whereas before I believe it was 1,133. So then we can consider the tax savings then. Before this, in just a tax calculation, it was 1,133 minus the 553 is 580. So we save basically 580 from the tax calculation based on the deduction, but we had to put 5,500 into basically a retirement account, into an IRA, let's say, to get that. Now, there's another benefit possibly, which includes the credit. So that's what we're considering here on line 12. Now, the credit is being limited to take us down to 0. So now this 553 that we would still owe or have a liability of is now being taken down by the credit over and above the deduction of the 553. And that's reported on Schedule 3. So we have this credit, retirement saving credit, and we could see attach 8880. So here's form 8880, which is credit for qualified retirement savings contribution. And this would be, if we were to try to interpret or try to think about why the IRS would put the credit in there, a compensation to say, hey, maybe the 5,500 isn't enough of an incentive given the tax brackets at this point, and maybe the credit then can supplement that and further incentivize people to put money into a retirement account. So that credit then brings the amount of liability down to 0 in this example. In this presentation, we will discuss the question of, can you claim the contributions credit? This information can be found in publication 590A. Can you claim the credit? If you make eligible contributions to a qualified retirement plan, an eligible deferred compensation plan, or an IRA, you can claim the credit if all the following apply. So here's what has to apply as we put the money into some type of these qualified retirement plans. Number 1, you were born before January 2nd, 2001. Number 2, you aren't a full-time student, explained later. Number 3, no one else, such as your parents, claims an exemption for you on their tax return. Number 4, your adjusted gross income, defined below, isn't more than the $63,000 if your filing status is married filing jointly, $47,250 if your filing status is head of household, or $31,500 if your filing status is single, married filing separately, or qualified widow, widower. What does it mean to be a full-time student? Full-time student. You are a full-time student if during some part of each 5 calendar months, not necessarily consecutive, during the calendar year, you are either a full-time student at a school that has a regular teaching staff, course of study, and regular enrolled body of students in attendance, or a student taking a full-time on-farm training course given by either the school that has a regular teaching staff, course of study, and regular enrolled body of students in attendance, or a state, county, or local government. And so you might be asking, well, what does it mean to be full-time for that institution? Typically, the institution will have the requirements for what it means to be full-time within that institution. So you want to talk to the institution, what does it mean to be full-time? How much time is full-time? You are a full-time student if you are enrolled for the number of hours or courses the school considers to be full-time. So note the school is regulated, so this should be standardized. They should know what it means to be full-time. They should have a good idea and be aware of the requirements for a full-time status and part-time status as a student. Back to the text. Adjusted gross income. This is generally the amount on line 7 of your 2018 Form 1040 or line 35 of your 2018 Form 1040-NR. However, you must add to that amount any exclusion or deduction claimed for the year for foreign earned income, foreign housing costs. So note, we're thinking the adjusted gross income, whenever we see this AGI limits, we're talking about income limits. As our income goes up, the tax code will take away benefits that we get. And that usually is calculated on line 7 adjusted gross income. Note that if it's modified, then we have certain modifications then in accordance with that calculation here, those being foreign earned income and foreign housing costs. Oftentimes, those two not affecting many taxpayers, but affecting some, and in those cases, needing to be taken into consideration. We also have income for bona fide residents of American Samoa and income from Puerto Rico. Eligible contributions. These include 1. Contributions to a traditional or Roth IRA. 2. Salary reduction contributions, elective deferrals, including amounts designated as after-tax Roth contributions to A 401k plan, including a simple 401k, B, a Section 403B annuity, C, an eligible deferred compensation plan of a state or local government, a government 457 plan, D, a simple IRA plan, or E, a salary reduced SEP, and 3, contributions to Section 501c18 plan. So note, as you look at all these types of plans, just note that these are different types of retirement plans. They're similar in nature in that they're giving incentive for retirement. So we're putting money into these different types of plans to give it incentive for retirement. Most of them differing in terms of the qualifications for the plan and how much can be contributed into the plan. Once they're in the plan, once the money is in the plan, it often acts in a similar fashion because it's the similar type of incentive that the government is trying to give with regard to these plans so that we will save more money for retirement. They also include voluntary after-tax employee contributions to a tax-qualified retirement plan or Section 403B annuity. For purposes of the credit, an employee contribution will be voluntary as long as it isn't required as a condition of employment. Reducing eligible contributions. Reduce your eligible contributions, but not below 0, by the total distributions you receive during the testing period defined later from an IRA, plan, or annuity included above under eligible contributions. Also reduce your eligible contributions by any distribution from a Roth IRA that isn't rolled over, even if the distribution isn't taxable. The portion distributions received by spouse. Any distributions your spouse receives or treated as received by you if you file a joint return with your spouse, both for the year of the distribution and for the year for which you claim the credit. Testing period. The testing period consists of the year for which you claim the credit, the period after the end of the year and before the due date, including extension for filing your return for that year and 2 tax years before that. Here's an example. You and your spouse filed joint returns in 2016 and 2017 that plan to do so in 2018 and 2019. You received a taxable distribution from a qualified plan in 2016 and the taxable distribution from an eligible deferred compensation plan in 2017. Your spouse receives taxable distributions from a Roth IRA in 2018 and tax-free distributions from a Roth IRA in 2019 before April 15th. You made eligible contributions to an IRA in 2018 and otherwise qualify for this credit. You must reduce the amount of your qualified contributions in 2018 by the total of the distributions you received in 2016, 17, 18, and 19. Maximum eligible contributions. After your contributions are reduced, the maximum annual contribution on which you can base the credit is $2,000 per person. Effect on other credits. The amount of this credit won't change the amount of your refundable tax credits. A refundable tax credit, such as an earned income credit or the refundable amount of your child tax credit, is an amount that you would receive as a refund even if you didn't otherwise owe any taxes. So note, as we consider these credits down here, we're going to have credits on line 12, which basically can usually bring the liability down to zero, but not below. And then we have refundable tax credits down here, including the earned income tax credit and the child tax credit. So what we don't want to have happen is a credit up here to mess up other credits that might be more beneficial, including the earned income credit and the child tax credit. And that shouldn't happen because this item should bring the liability down to zero. We still have the refundable type credits, which could possibly be beneficial and give money back even beyond having any money paid in. And those being the earned income credit and the child tax credit down here in line 17 under the refundable types of credits. Maximum credit. This is a non-refundable credit, so it's non-refundable, meaning it can only take the liability down to zero, not below. In other words, this credit can't result in a refund or money that would be received past the liability or any money that would be owed. So in other words, the liability goes to zero and then it's going to be stopped at zero. And so it's not going to say it basically says you don't owe any taxes, but you're not going to get money beyond owing taxes. Whereas the refundable credits possibly could. The earned income credit and the child tax credit could possibly result in a refund or money beyond any tax liability without paying any money to the government. So that's going to be the difference between those two. The amount of the credit in any year can't be more than the amount of tax that you would otherwise pay, not counting any refundable credits in any year. If your tax liability is reduced to zero because of other non-refundable credits, such as the credit for child and dependent care expenses, then you won't be entitled to this credit. So if the tax is already being taken to zero, then typically you're not going to get this credit because the tax is already taken to zero. It's already gone down as low as it can go by this credit. You don't, in essence, need this credit to have it go down to zero. And then therefore the difference could be applied out for those types of credits that may take it below zero in the refundable credits section down below. How to figure and report the credit. The amount of the credit you can get is based on the contributions you make and your credit rate. Your credit rate can be as low as 10% or as high as 50%. Your credit rate depends on your income and your filing status. See Form 8880 to determine your credit rate. So we're gonna file the Form 8880. So that's gonna be this item here, and we'll go through the calculations to determine what the credit rate will be. And then of course we're gonna be limited to the amount that's basically our tax liability and in terms of how much we're gonna get on the credit. This then will flow through to the Schedule 3. So here's the Schedule 3, which will then flow through to the 1040 on line 12. Back to the text. The maximum contribution taken into account is $2,000 per person. On a joint return, up to $2,000 is taken into account for each spouse. Figure the credit on Form 8880. Report the credit on Schedule 3, Form 1040, line 51 or line 48 of your Form 1040 NR and attach Form 8880 to your return.